Good afternoon, everyone, and thank you all for joining us. We are very excited to welcome our guest today, Meera Pandit, who is a truly distinguished voice in the financial markets. Meera is a global market strategist at JP Morgan Asset Management and a frequent contributor across major financial media, including CNBC, Bloomberg, and Yahoo Finance. She is widely recognized for delivering timely insights on the global economy and capital markets and plays a key role in shaping JP Morgan's market outlook and research. And we're very happy to have her. So thank you for joining us, Meera.
Thank you very much for having me. It feels like it's certainly a volatile time in markets, but it's always a little dangerous doing calls around this time because you hang up and you're like, has the news changed? Has something shifted? How do we process this information day in and day out, hour by hour? But I'm going to try to give you all an overview of how we're thinking about this year unfolding and what has changed from our outlook from January 1 to where we are today, given some of the events unfolding in the Middle East. How does this actually shift things? Because the reality is for us, it's not changing our outlook meaningfully yet. Look, if this crisis goes on for many more weeks or many more months, and particularly not just around the military operations, but more around the free movement of oil, then it could create some pretty challenging environments for the global economy. But if we are able to get out of this in the shorter term, then it shouldn't actually meaningfully shift the way things play out for the rest of the year, somewhat similar to how the first half of last year unfolded. So let me share a couple of slides from my guide to the markets here.
Perfect, thank you.
Let's start off with the market impacts that we've seen so far from the war in Iran, whether they are expected, whether they are in line with history or not. We can't predict the future, but we can use history as a bit of a guide and help us to decipher how things have played out in the past and therefore the knock-on effects this time. So the S&P 500 today is down about 3% year to date. It was down about 9% at its max from the beginning of this challenge here. But what we've looked at here is the history of geopolitical shocks and their impact on the equity markets, which specifically on the S&P 500 are relatively limited. So this is in line with a lot of the different geopolitical crises that we've seen in the past. So you can see all of these different events that we've seen over the last 50 years. And then at the bottom there, we tabulate the median drawdown in the S&P 500 is just over 5%. And if you think about the time it takes to fall 5% and then recover to the prior value, it's about 1 month of a round turn. So far, relatively in line with that. Now, markets hate uncertainty. That's really what drives the bulk of this drawdown. But why don't markets react more to things that are going to reshape history? Well, part of it is if you think about the S&P 500 in particular, if you think about a globally diversified portfolio, even the most diversified portfolio is not going to have a huge exposure or maybe any exposure at all to the Middle East. And that's where a lot of these various shocks are emanating from. So in that case, the actual direct exposure to this conflict is limited. So how do we typically think about the exposure and the pass-through effects from geopolitical conflicts? Well, if you look at that 5% median drawdown on the S&P 500, if you replaced all this data on this page here with oil prices, you typically see about a 25% oil shock and spike. So certainly if we look at where we are today, we've surpassed that and we've seen a big jump in oil prices. So if you look at the right side of this slide here, we look at WTI oil over time. And you can see where we are as of yesterday's close at $112 a barrel, up from just $55 in the middle of December. So it was not far long ago that we were at half of where we are today. So we have seen this huge rise in oil prices, but the history again with geopolitical shocks is, especially more recently, you tend to see that impact on oil prices is relatively short-lived, a couple of months' time, as opposed to a couple of years, and things do start to regulate and reset once we get a little bit of a clearer path on oil supply and oil movement. But how we think about oil as it relates to the global economy, and specifically the US economy, is it's having a consumer impact. And this is so important because if you look at the US economy, about 70% of spending is coming from the consumer. And about 70% of our GDP overall is just what the consumer is doing. So the way the consumer goes is the way the economy goes. Now, what you can see on the left is the consumer impact so far is this pass-through to retail gasoline prices. So here we look at the rise in retail gasoline prices and the fall in some cases as well, from the beginning of the year to the end of the year over the last 4 or 5 years. And the most relevant data point on this page here is that lighter blue line, which looks at 2022. War between Russia and Ukraine happening just around the same time that year as this year, the end of February. So you can think about how these conflicts play out in essentially in pretty simultaneous order here.
Yep.
And if we had the most recent data point from yesterday, this updates about weekly, you would see that orange line jump to match where the blue line is. So we're seeing a very similar impact to what we did in 2022. And actually in 2022, it continued to get a lot worse. But then you can see that it then sharply got a lot better and things readjusted. Nonetheless, the impact today to consumers is that they're spending more at the pump. And they're actually also spending more on things like groceries and food, because a lot of the byproducts of oil, when we think about petroleum and petrochemicals, include things like fertilizer, plastic, packaging, etc. So you look at that bottom right-hand chart there, and we look at the consumer spending on energy products. For the bottom 20% of the population, it's about 17% of their pre-tax income. It's about 10% for the bottom 20 to 40%. That middle range there is still about 7%. So these are sizable parts of people's budget, and there's no better broadcast price in the country than gasoline, with people filling up the tank every day. So it does also feed into the way consumers are thinking about their finances as well. Now, while in isolation, this might slow the economy and slow economic growth, there are two potential countervailing forces. One is the fact that consumers this year are getting higher than typical tax refunds that are elevated when you think about some of the changes from the One Big Beautiful Bill Act. So if people are getting some more money from that nice big check from a refund perspective, it's coming right at a time where it can offset some of these higher costs. Now, if we also think about the unpopularity of paying more at the pump, that is not something that goes unnoticed by politicians. So especially in a midterm election year, you may see some direct-to-consumer type of fiscal stimulus by the summertime to juice up the economy a little bit before people go to the polls. So all of that together could actually keep our overall economic growth afloat and to a decent growth rate. Yeah. The other thing I'll mention, more economy-wide, is going counterclockwise here on the top right. We are just less sensitive to oil prices than we once were, because we used to be a massive importer of oil, and now we are a net exporter. So we actually benefit a bit from the higher prices, but also, again, are just less sensitive to that. What's not pictured here is, as an economy, we are also more fuel efficient in terms of cars, more energy efficient in terms of appliances and buildings. So all of that also helps to blunt some of the blow from higher prices. So economic outlook still intact as a result of the countervailing forces of elevated tax refunds and potential fiscal stimulus.
Do you have some concern? When we're speaking about just markets as a whole, I mean, U.S. obviously has a much less reliance on oil. The rest of the world certainly has a lot more. I mean, you're hearing concerns with the Philippines, having like 1 month that they didn't let the boats go through, or Japan. A lot of those Asian countries rely much more heavily on oil. So could there be a drawdown just more so to U.S. markets if some of those countries continue to struggle to get access?
I think you're seeing varying drawdowns in different areas as those impacts play out. So, for example, you mentioned the Philippines. A lot of the areas within Southeast Asia, for example, and different parts of Asia are already rationing and experiencing shortages and having some issues. Areas like Japan are bringing in a lot of energy and bringing all their energy from outside of Japan, but their reserves are sufficient. And they're already doing fiscal stimulus, essentially, and doing price caps to support the population in the meantime. So they are kind of playing the right amount of defense to support markets. Areas like China are actually less exposed than you think, even though they get a lot of petroleum from, or oil from, that passes through the Strait of Hormuz and from Iran as well. But they're very coal dependent still, and so that that insulates them quite a bit. Europe is an area that is struggling quite a bit. They struggled a lot just 3 or 4 years ago now in 2022, but they also dealt with a much bigger energy crisis 4 years ago than they are now. So they are adapting and they're more equipped to adapt, but I think that they're a lot more exposed than the US. So certainly other parts of the world are exposed to different degrees based on who they're getting their oil from, what their baseline energy mix is as a country or region, and how much inventory and storage they have to survive in the meantime.
Is there and you were hitting on this before, but just a time period? So if this lasts, let's just say this conflict, and again, I think tonight we're going to have a much more binary event. I'd love for you to kind of walk through, how you guys may be forecasting that if things get substantially worse and, maybe there is some sort of attack on, direct energy in Iran, how that may affect things. But is there a period of time like, hey, if we were able to get some sort of called ceasefire, over the next month or two, or if this takes on like 6 months, how that, flows through to the energy markets. And then maybe I'm sure you're going to hit on this now, but, speaking a little bit more to the inflation issue that could, come more down cycle.
So in terms of the first point here, in terms of how long this lasts, I mean, that is the key. And the outside of this is, if this is a 4 to 6 week thing, then it's an entirely absorbable shock. Well, we're in week 6 now, so this is kind of the crunch time. 6 months, I think if this lasted 6 months in terms of having the Strait of Hormuz disruption, that's what we're most focused on from an economic perspective. You see areas like Russia and Ukraine where like the fighting continues to today, but it's really about that movement of oil from that economic vantage point. If you see that Strait of Hormuz closed for 6 months, we would be in a global recession because you'd have a bigger shock to oil supply than you did during COVID. So this would be like 100 years shock. So that would be very bad. It's in nobody's interest to see that. And ultimately, look, the calculus here a little bit from our perspective is from a political standpoint, you don't want to see that much pain for your consumers. And the longer straits close, like you still see that oil prices globally, even though we have our own supply. So I think that there is a threshold of economic pain. It's less about the market pain, but more about the economic pain that the administration might be willing to take on. But again, I personally, it's so hard for us to predict geopolitical outcomes because we are thinking about things from the vantage point of like, how do you limit economic and market damage? But that's not always the vantage point that the politicians are thinking about. And, I think sometimes we think, oh, but like elections are won and lost on recessions and inflation. We've seen that over the last couple of years. But again, that's not always from a political perspective, the calculus that's being made. So that always impairs our ability to understand like how long this might last for. But, again, a few more weeks, we should be okay. Much beyond that, as we start to get into like May, that is when a lot of inventories run down and then you start to see some real challenges.
Have you guys baked into or started to analyze? I imagine you guys have at some level. If we had some sort of situation today, for example, where it escalated much further and we did attack, some sort of energy depot within Iran and things got substantially worse, have you guys thought through or what that may look like? Because I think that's the biggest question I'm getting now.
Again, I think if we have a massive disruption, if it looks like the strait is not going to open for months, like that is a global recession. That is a COVID style period. Like that will be a big shock. We are assuming that is kind of base case is that won't happen because I don't know what anybody really gains from that in all of this. Whether nuclear deterrence is worth that in the short term, or if there's a more effective way to get to that. But yeah, the bear case is quite bearish. When we think about the base case, though, and we look at inflation, the inflation impact, and again, we can use 2022 as a test case, could be relatively short-lived. So what we show on this slide here is contributors to headline inflation. We can see where we are today at about 2.4%. That, of course, is stale. As we get data this week, it is likely to show a number above 3. And over the next couple of months, you're likely to see that rise, we think, to a peak of about 3.6%, again, on overall inflation. driven higher by energy. And if you look back to 2022, you can see in green that energy component was a big shock there. But again, it was relatively short-lived. And then you see the flip side of it where energy is actually pulling inflation down. We think that's what will happen by the back half of the year. So that energy is a big problem in the first half. The second half, by the end of the year, it's actually helping bring inflation down. And probably the same thing with food in purple, given some of the knock-on impacts of food here. What you're also likely to see by the second half of the year is some of these lingering tariff impacts starting to fade a bit more. So while we do see an inflation spike, it's not going to be anywhere near like what we saw in 2022. And again, we do think the flip side here is that it starts to come down and really alleviate some of that inflation pressure. What I'd also mention that is different than 2022 is take out the food and energy, the green and the purple, and everything else was really strong from an inflation standpoint because consumers had a ton of stimulus, they had a ton of money they were spending, and so it pushed up core inflation, which is everything outside of food and energy, which is what the Federal Reserve pays attention to the most. This time around, I think consumers are not flush with money as they were at that time. So if gas and food cost more money, they may actually cut spending from other categories, which could actually shrink core inflation a bit more over time as opposed to add to it. So when we think about what the impact is then on global rates, and particularly within the US, our central bank, the Federal Reserve, and their reaction function, we don't think they're going to do a whole lot around this. They're probably going to just wait it out as opposed to think about raising rates. Because again, those headline inflation spikes tend to be short-lived. Core inflation is not necessarily looking to be a challenge. And the backdrop of the labor market is not that strong. So this slide here looks at the federal funds rate over time. You can see in green market expectations, the Fed's expectations in blue. This was from a few days ago, so market expectations have been all over the place from 2 cuts this year to then a hike to now basically no real movement on rates. The Fed has been remarkably consistent. In December, they said 1 rate cut for the year. In March, they said 1 rate cut for the year. We'll see what they say next quarter, but ultimately, maybe we could get 1 rate cut in December, but we're not necessarily forecasting rate cuts.
If we only see one rate cut, I mean, how are we pricing the market at that level? And if you start to see, that rise in the more near term on inflation, does that lower market expectations? Given such high concentration in, large tech, for example, how would you guys consider the, influence on that?
So I would say from an inflation perspective, even if inflation goes up in the short term, it doesn't mean inflation expectations, which is something the Fed pays a lot of attention to, become unanchored. So far, they haven't. So they, kind of weather out the storm a little bit here. When we think about rate expectations right now, look, I think the 10-year has probably gotten a little bit higher than it needs to be because you're not really seeing much movement around inflation expectations, and we're probably going to see weaker growth. So I think there's a little bit of room for that to fall, but not too much. And I think the 2-year, there's some room for that to fall because I don't think the Fed will actually hike rates. So rates are looking probably a little bit toppy right now, and I think there's some room for them to come down in terms of market-based measures. But yeah, I think that going forward, when we think about the bond market, it's really less of a focus on movement in rates. We've just seen so much of that in the last couple of years, so much rate volatility. It's very much shifting to, well, rates are going to be more range-bound. Let's think a bit more about income and how income not only generates yield for a portfolio, but also protects. Now, 2 silver linings here I do want to point out in terms of giving some context to the situation. One is, yes, there are some headwinds to consumers, but consumers are starting from a position of strength. So what you can see on the left-hand side is the consumer balance sheet. You have about $10 in assets for every $1 in liabilities. And people always talk about how much consumer liabilities have gone up, and we've never seen more consumer debt ever. Well, that's a nominal number. That's always going to rise. And by the way, the assets have risen a lot. You can see home prices in purple, a quarter of the consumer balance sheet. Those have risen a lot, even though they're starting to stagnate. You've seen financial assets, the assets that are in retirement accounts also rising. Deposits are paying pretty good interest. So consumers have actually done quite well on the asset side. And on the liability side, most of that is mortgages. And now you see that homes are for the well-heeled. I mean, it's not really a function of, oh, people can't afford this mortgage that they have. It's that people can't afford to take on that mortgage in the first place because rates are high. So it's not that it's so burdensome at 6 or 7% mortgage rate, because usually the people who had those rates are able to afford them at this point. So you have the average age of a first-time home buyer now. First-time home buyer is 40, and a huge amount of houses that are being bought are second homes or second-time buyers. Now you look at the top, and it's not, again, about how much debt there is, but your ability to pay it. And so we look at the debt payments as a share of overall disposable income, and that has come down quite a bit since the financial crisis, and is actually relatively in line with the area in which it flatlined after the financial crisis. And you even did see like a dip where you have the COVID crisis, where rates went down to zero, where people had a huge amount of disposable income because of those stimulus checks, wages went up. So that was actually a positive development there. Again, now we're kind of back to normal, so nothing in the aggregate to worry about. Now, under the hood, again, there are some areas where you're seeing elevated delinquencies, student loans, obviously, after a long moratorium there. But you're not seeing, again, mortgage delinquencies are still very low. Credit card and auto loans have perked up a bit, especially at the lower end. But there's always going to be some sort of distribution there, as long as the aggregate looks okay and the cracks underneath the surface are not too deep, which we don't believe they are. And then the other piece of this is corporate profits, because if there was a war, no one told earnings growth. You can see on the left-hand side here in that box, usually earnings grow about 7 to 8%. But in the last 2 years, they've grown double digits. And this year for 2026, you can see on track for 17% growth. And that was up from just 15% if you looked at January 1st. So as all of this has unfolded so far this year, earnings growth has actually, and expectations have actually been revised up. And you see the highest number of companies within the S&P 500 expecting, guiding positively in the last 5 years. So corporate America seems to be pretty sanguine about all of this. Our investment bank does do estimates of, how much could this war impact profits? And they say 5-ish percentage points. But again, if you knock that off of the 17, you're still in double-digit territory. So the buffer here is pretty strong from a corporate perspective, pretty strong from a consumer perspective as well. Now, maybe just rounding out on two more things, just thinking about investing principles and overall portfolio management. Patience is definitely a virtue when we have these periods of volatility. What you can see here in gray is the calendar year return of the S&P 500 over time. And then in red, the maximum the market fell. So this year, the market fell about 9%. We are down about 3% year to date. But if you look back over time, on average, the market falls about 14%, which I think is an important point, because it means we always know that there's going to be volatility every single year. We don't know when, we don't know why, but we do know that there will be. And that's why we build portfolios in a resilient way to manage that. And one of those ways is having a longer term time horizon and not trying to trade too much around volatility. Because ultimately, by the time volatility settles down, markets have already settled up. So you often miss that initial rally if you try to get out of the market and then come back in. And you can see here the turnaround time can be pretty quick. I mean, in the last 40 plus years, 45 years, literally 46 years, 75% of the time that calendar year return has ended up positive. So we do want to be a little bit patient with the volatility we have, which relative to history right now is actually less than what we typically see. Now, one of the ways we manage that is, again, having that longer term time horizon. The other is being diversified within our portfolio. Now, there's this tension between, okay, we are diversified, we're looking for the appropriate hedges of different risks. So the way we think about it is you hedge against the risks you diversify against the risks you don't. And if we think about the performance of various hedging strategies so far this year, this slide here is a scorecard top to bottom of different returns in different asset classes. And you can see where we are year to date, that commodities are the number one spot. Obviously, you have higher energy prices, higher agricultural prices. But underneath the hood, you've actually seen gold down about 11% since the war broke out. So that has not had great hedging properties. You have seen areas like the dollar up about 2.4% since the war began. That has been a good safe haven. You've seen Bitcoin have a little bit more of a rally in the last couple of days, but not a huge showing considering that the first 2 months of the year it slid by 25%. So
Yeah.
ultimately, when you look at diversification here, you can see all the way at the bottom, the market is down about 3%. But if you look at that white box, that's asset allocation, that's a balanced 60-40 portfolio, you're up. So to be up in a down market is pretty powerful when you think about everything that is going on and wanting to just simply preserve capital before we can get back to capital growth when some of the sky is clear here. So maybe with that, I'll pause. I'm happy to answer a couple of minutes of questions if we have them.
Yeah, I got a few. I got a few. I mean, overall, it seems like you guys are pretty optimistic on where the market can go, assuming we get a ceasefire when it comes to Iran.
Yeah, I think so. And again, the bear case is pretty bearish, but outside of that, if we are more at our base case, then we could be in a position where this has an impact, but not a long-lasting one.
Any, do you guys have, I know one of the other hot topics outside of Iran was more in the private credit space. Do you guys have any concerns about that continuing to linger or, be a cause for a future larger drawdown?
I think there's three different concerns around private credit right now, and they're not totally related. One is we had a couple of high-profile fraud cases over the last year or so, and so that got people a little bit spooked. Two is there's concerns about software and software exposure in private credit. But by the way, the high-profile bankruptcies and fraud, we're not in software. Those are unrelated sectors. And even within software, yes, like there's huge exposure in private credit to software and tech. Well, by the way, there's huge exposure to software and tech in the S&P 500. And that is all public and laid bare for people to understand. There's huge exposure within the Barclays Ag, if you think about bond markets and their exposure to technology. And look, there's been sell-offs in certain places, but not absolute decimation of the market as a whole. So there will be pockets of stress, but I don't think that shifts the whole industry within private credit. And then the third thing I think is just a fundamental misunderstanding of the way some of these vehicles are meant to operate. You are meant to marry private credit, not date it, which means just because you want the liquidity at a certain time doesn't mean you're going to get it like you do with a stock or a bond in the public market. So I think that there is some vehicle misunderstanding that people are going through right now. Ultimately, though, the biggest problem for private credit is one day when we go into recession, then you start to get higher default rates and you see some more challenged behavior. But we don't see that in the next year because we're not necessarily forecasting recession. And perhaps if we did go into global recession due to the energy crisis, like private credit would just be one of the many casualties. Like the entire market would have a lot of challenges here. So I don't think that there is this big looming risk around private credit. I think that there are just cross currents of different pain points that people have conflated into one and kind of made more of a boogeyman out of than probably warranted.
Is there anything else that's concerning you guys, more in the near term that could be, could cause a drawdown?
It's always the risks you don't know about and you don't expect that create challenges. So I'd say there's nothing specific on our radar right now. Certainly the geopolitical challenges are a problem. Predating the geopolitical challenges, there were concerns about AI, but we do feel that the fundamentals within AI have not really changed. It's just more the sentiment that has changed. And look, longer term, there are still debt deficit issues that we will be grappling with, but that's more of a medium-term concern as opposed to a short-term.
Yeah, I would imagine too, depending on how this shakes out in midterm elections, that could have a big impact on, ultimately some of those concerns. I could probably fire out a million questions, but I know you're on a tighter schedule. I guess my last two would be, gold and Bitcoin have been brought up to me, so many times over. How are you guys looking at, those asset classes now? Obviously, with gold most recently, a little bit of sell down, and Bitcoin's continued to kind of been range bound more recently. How are you guys looking at those prospects into the future?
From a gold perspective, look, it just tends to have higher volatility and lower returns over time. While it's been a decent inflation hedge, you're seeing right now that it's not the best geopolitical hedge. And it just ran so far last year, which reeks to us of some speculative activity. So that gives us some pause in terms of wanting to join the gold bandwagon. And certainly, again, the function it should play in a portfolio, which is mitigating some of this volatility, has not worked. So I'd say we're not typically gold bugs, especially given the yield backdrop right now, and certainly given how it has played out over the last couple of weeks. And then Bitcoin, we've always struggled to find the right place in a portfolio for Bitcoin, given that not it's not a hedge, it is speculative, but it doesn't really give you earnings growth or any sort of predictable nature in terms of what might make it go up or down. So just from a risk return perspective and a risk management perspective, we don't find the right role for it in a portfolio. So it just isn't an area that resonates with us.
My last question. I know you get one of the concerns that I have, right, is if we look at just US markets, maybe over the next 5 years, I know you guys run those 5 and 10 year market assumptions. They look pretty minimal for returns in the US markets. Do you see any areas of opportunity over the long run? And then, speaking to that diversification, any particular markets you guys really love over the next maybe 10 years, whether it's Japan, India, or whatever that may be?
Sure. I think that markets that we feel good about over the next several years